earnings, and one such candidate is Gulf Oil that has reported its quarter three earnings, largely in line set coming in, except for a slight bit of a miss coming in on the PAT. But let me get you on board the management. Ravi Chawla, who's the MD and CEO of Gulf Oil Lubricants, joining us now. Hi, Mr. Chawla. Thank you so much for joining us. Mr. Chawla, this was your first all-time high quarter on volumes and revenue and EBITDA. Also, with revenue that's up 10%, EBITDA that's up 7% on a year-on-year basis. But like I mentioned, the PAT was down 21% due to the labor code provisions. How should we think about the sustainable EBITDA margins and PAT run rate once these one-offs are behind us?
Well, we have had an excellent record quarter, as you know from the numbers, except the one-time adjustment of the labor and last time we had an asset sale. I think the trajectory for Gulf continues where we've been growing 2 to 3x the market. Our margins also improved quarter on quarter and also around 13%. So we have that band of 12 to 14%. And our volumes are again 2x of industry, in some segments 3x of industry. So I think the trajectory for us is unchanged. It's been a record quarter in terms of, and as you can see, our healthy profit margin growth, healthy volume growth overall. And for the year also, we are at 11% growth of revenue. We are at 9% growth of volumes, and our profits are up 8.6%. We have seen recently that there was some price corrections taking place in the market. That goes well, and the input cost is also stable. Of course, exchange rate has been a challenge which we are managing through pricing and other routes.
Let's talk about OEM franchise workshops. FWS delivered all-time high volumes with high double-digit growth in PCMO and MCO. What is the current revenue mix from OEM FWS, and what is your medium-term target for this channel?
Well, this is a very important part. Gulf has more than 50 OEM tie-ups, and a lot of them are in the franchisee workshop. So this forms a very important part of our sale and has been growing quite well. And it's close to about 25-30% of our volumes in terms of our business. And we have seen that this is growing across segments as mentioned by you in terms of passenger car, agriculture. We have, of course, commercial vehicles, construction OEMs. So I think this is where we continue to play on this strength of ours. And we have a very exceptional distribution and service network for our OEM franchisee workshops, which is one of the reasons where we have been able to grow at this pace.
Mr. Chawla, you also highlighted the good double-digit growth in industrial, infra and mining lubricants driven by the new customers. Could you share the size of this B2B industrial book today and the growth aspiration over the next 2 to 3 years as well?
Well, this segment and a lot of segments where our market share is still below 5%. One of them, as you mentioned, the infrastructure and mining. This has been a focus for us for more than a decade. And we have been growing double digit in this segment right across in terms of current customers. We have marquee customers like L&T. We also have tied up recently with 3 new OEMs. This continues as you see India getting into infrastructure in a big way. This is a strength of us. And right now, of course, the infra segment is more than 10% of our volume. And if we look at overall in terms of without the OEM business, and if you look at this segment, it is also a segment which is growing. And we believe that given the mix we have and given our strengths, we'll continue growing double digit in this segment for the next 5 to 10 years.
All right. You have 3 EV-related investments, Tyrex, Isra, and Tech Perspect Electrify. With recent wins at Mahindra's highway charging initiative at VinFast, how do you see these pieces coming together into a coherent EV ecosystem business? And when could this become a meaningful percentage of consolidated revenue?
Well, for our DC charging business with Tyrex, which has also started making AC chargers for MG and VinFast, DC chargers mainly going into bus OEMs and other charge point operators and other public utilities, etc. We have obviously set up a vision for this Tyrex in terms of the business we can get. And given that there are lots of challenges in India setting up the charging infrastructure, I think we are part of this momentum to establish charging. We have a software company which is also contributing to bring it all together. So I think in terms of this business, we are looking at least to 4 to 500 crores in the next 3 to 4 years where we can fructify. Of course, it depends on how soon we can get the charging infrastructure because a lot of the sites need to come up A lot of the EV buses need to come, and we are seeing that even in the case of car and car OEMs like MG and VinFast and the others, we have a role to play. Given our strength with the OEMs and our infrastructure customers, I think it's a synergy which is very good for us, and we are well placed for that.
Mr. Chawla, over the next 3 to 5 years, what is your targeted revenue CAGR and EBITDA margin range from the consolidated business, and how much of the growth do you expect to come from your core lubes, the AdBlue and batteries, and also the EV charging and digital services?
I think for us, we have Unlock 2.0, which is to accelerate, to premiumize, and to transform. Transformation is both digital and our mobility. When we say accelerate, we have been talking about 2 to 3x the market, which we'll continue focusing on, and we are very confident of that, because not only do we have headroom, we see that there is a lot of potential, and our proposition is really going strong. We look at our B2B businesses growing well. We are really looking at AdBlue, where we are a leading player. We will grow close to double digit. Of course, there we are increasing the distribution, innovative reach to customers, and also digitizing in terms of overall core business. So I think overall for us, it is going to be a growth trajectory for core business, and transforming and increasing the mobility piece. And of course, getting into segments where our market share is less than 5%, with at least a 3x kind of growth vision.
All right, with INR depreciating, still a headwind, and base oil prices relatively stable, how are you hedging FX and commodity risk, and what band of gross margin are you comfortable guiding to over the next few quarters?
See, the margin, if you see, this quarter has gone up to 13%. It has moved up by 0.6% over last quarter. So you're right, the exchange rate has fluctuated. We obviously do our adjustments in terms of our hedging and the exposure, but definitely this has been a cost that has come in. We're happy to share with you that we are also seeing the market making some moves. So we had initially made some moves on the price that we are seeing happen. And as we have been saying, 12 to 14% is a band in which we want to operate, at least in terms of our decision making. Ideally, with our product mix and other such initiatives and stable pricing and exchange rate also getting taken care of, we would like to move up to the next level of 14 to 16% EBITDA margin percentage band. And I think we are definitely looking at a stable crude price, which is translated in base oil, but exchange rate is something we have to wait and watch, and we'll continue to adjust and try to be towards the higher part of the band.
Right, finally, Mr. Chawla, the PCMO, Agri and the MCO all saw high double-digit growth, and the OEM FWS volumes also hit an all-time high. How is the product mix shifting between the premium synthetics versus the conventional loops, and what is the margin gap between these buckets?
So synthetics and semi-synthetics, obviously, they are applications at a higher level. So there is more value in that. And as we move towards this, we've been launching products like Syntrack, which is our new motorcycle range, which is for high-end bikes. Similarly, in the case of industrial, we have introduced some synthetic gear oils. So I think this endeavor to move into the value-based is definitely where the industry is also growing. For us, we have a single-digit figure in this. So again, gives us the potential to grow. And some of the offerings we have, including in the passenger car motor oil, which is synthetic, we are very confident that we'll be able to take up our market share significantly. So if we are going 2 to 3x, we would at least like to grow much higher than that in these grades. So new products and movement towards value-based synthetics, of course, they are at a higher price and offer more efficiency, more service. And we are confident that we can take this in the next few years to a double-digit kind of percentage of our sales.
All right, Mr. Chawla, thank you so much. It was great having you on the channel, and thank you so much for talking on the numbers today. Thank you.